Welcome to Fidelity Soundbites, a straight-to-the-point monthly podcast where you will learn from some of Australia's leading portfolio managers on what's happening in markets, how they're positioning their portfolios, and the outlook ahead. I'm Andrew Dowling, your host, and in this episode, Paul Taylor is back to reflect on February's reporting season, how the market is feeling, and where earnings is expected, and how did the month of February go as a whole. We're about to find out. Great to see you, Paul.
Andrew, good morning. Great to see you too.
So, Paul, looking back, this February would have been your 40th reporting season since you established the Fidelity Australian Equities Fund 20 years ago, or nearly 20 years ago. Any particular takeouts that you'd like to share with us at this point?
Yeah, definitely. I thought it was a really interesting reporting season. It's an interesting time. If we just look at the performance of the market, it was down a little bit through the month of February, but there's probably a bit of an overlay. There was what the companies actually reported, but then there was also some macro overlay as well. We can get into that in a little bit more detail. But look, I thought the reporting season itself was broadly okay. I think there was actually more downgrades and upgrades across the market, but I think it was probably separated between large cap and small cap. So maybe I think there was probably more small caps that had that slight downgrade, and maybe they're just more exposed to consumer. They're just more exposed to consumer cyclicals. It's a little bit tougher area, but look, broadly okay. I thought in terms of sectors, insurance was a good. Insurance had a great result. Healthcare was good. So those sort of sectors did quite well. Essentials did quite well. Consumer staples, I think they just showed their resilience through this as we're starting to get into a slightly tougher period. Some of the weaker areas were probably contractors, capital goods, and consumer discretionary, but particularly in the sort of goods space as well, is just starting to decline. So it may be a bit of a turning point, which I think will be interesting to look back. But then from a macro perspective, interest rates keep going up. So now, as we sit here today, Reserve Bank 3.6%, still probably a little bit, whether there's one or two more. Definitely through the month, which I found really interesting, there was a lot more negativity towards the RBA and towards the governor, which is also I take that as there's pain entering the system. That's what I take that as. So I think we've been talking about interest rates going up for quite a while, and they have gone up, but I don't think they've actually done too much. As we've gone from 0 to 3, there really hasn't been much impact. But now at 3.6, you can almost feel a sort of bit more pain entering the system.
Yeah, and look, it's a good point and good timing in terms of to your point, we've seen variable interest rates on home loans pretty much double, right, since March of last year, certainly over the last 10 months. So more and more households are probably starting to feel like they're moving from living to existing, whereas on the other hand, the income on term deposits has increased dramatically. How do you build those very, very large either positive or negative shifts in household income into your thinking around portfolios, companies, sectors?
Yes. So it's a good point you make. So people, obviously the market, people generally just focus on the negative aspects of interest rates going up. But you make a good point that, pensioners in particular have been living with very low deposit rates for quite a considerable time. So you now are starting to get, 4% fixed term deposits and even sort of high threes on at-call accounts as well, which will be positive for people, for savers and for people maybe in pension mode as well. But the big impact really has been targeted towards mortgage holders. And the other interesting thing, we touched on it last podcast as well, is that this time around, probably more people, it was estimated about a third of home buyers or more people with mortgages went into a fixed rate mortgage, which is quite unusual in Australia. Australia's predominantly works on variable rates. Now, those fixed rates they have been rolling over, but they start to gain momentum through sort of May, June, July, June being a little bit of a peak. So I think it's really going to be interesting as we move into the next 3 months, as people move off those very low fixed rate mortgages onto the variable rate. And that could be quite a significant increase. Now, for those people, that's a big dent in their disposable income. And obviously they're going to have to, pull back on spending. And I guess as we look to the year, and that's a big reason why, we still think essentials is the right place to predominantly be in the portfolio. And what we saw through reporting seasons, the supermarkets, healthcare, et cetera, continue to do quite well because they're areas people have to spend on, regardless of the environment. So, once again, I've also talked about, essentials being a half of your wallet. That's maybe gone up to 60% due to inflation. And then you've also got the shift between goods and services. It was actually interesting in the RBA announcement as well, the first time they broke out goods inflation and services inflation. So goods are the inflation is coming out of the goods sector. But the inflation really is in the services sector because that's where people are spending their money now. So we were all about goods in COVID. We've come out of it now. We're all about services. People want to go on holidays, want to eat at restaurants, they want to do experiences, they want to travel. And that's where we're seeing the inflation. And that's where, and actually one of the areas that continued to do quite well in the reporting season was also sort of COVID recovery plays as well, travel agents, airlines, theme parks, sort of tourist destinations. So, like that higher interest rate is definitely going to, pull back the consumer. I think our base case is still that Australia doesn't go into recession, but as I pointed out last time, I think that's still a risk factor. Once again, in the latest RBA release, they started to talk about we're getting close to where we need to get to on rates, but market expectations are still probably one or two more, so getting close to that 4% rate or a little bit over the 4% rate even.
Yeah, and if we are close to that pause in RBA rate hikes, obviously it provides a little bit more certainty around what funding might look like short, medium term. Obviously, companies, when they are looking to invest or invest back in themselves, it's typically on a longer-term basis. But does this new, for want of a better term, risk-free rate that companies might assess off, does that change the thinking around projects? Does that change the thinking around acquisitions, reinvesting? What are you seeing across companies and how they're thinking about growth and opportunity?
Yeah, look, I don't think it really changes their assessment of required rate of returns on projects. And even for us, when we try to value individual companies, a big part of that valuation, the discounted cash flow, is to discount. A big part of it is the risk-free rate, as you highlight. Now that risk-free rate, probably got all the way down to 1%. But I don't think, so we certainly didn't in models take the risk-free rate to 1%, and sort of 4% was about where we bottomed. So we didn't go down to 1, but we haven't come back up from 1 back up to 4. And I'm sure companies are the same. So when they've assessed projects, I'm sure they didn't take their risk-free rate down to 0 to 1%, which would have made pretty much every project extremely attractive. That they're still looking, so if you follow that through in the model, it's probably, projects would still be, people would look at for 10 to 15% return on most projects. So that really didn't come right down when the risk-free rate went right down, but it hasn't necessarily gone back up as well. So I don't think there'd be certainly not from our perspective, and I don't think there'd be a huge change in the way corporates viewed CapEx and investments and projects.
And just with the banks, they're obviously a valuable insight into the broader economy itself and what's happening. Are they concerned about the impact of rate rises? Term deposits, obviously that's good for sourcing funding and less offshore funding requirements. What's the view there across the board?
Banks are a really interesting one, and they have there's probably short-term and long-term consequences. So in the short term, what we've seen from the banks is that their net interest margin, which is basically the difference between what they lend at and what they borrow at, that spread is the net interest margin. Now that's been going up because as interest rates go to zero. So if you just look at the deposit side, in a transaction account, they're often at zero that they're giving you on your transaction account. But when interest rates are 5%, they're making a net interest margin of 5 on the deposit side. But then as interest rates go from 5 to 1, they're now making a 1% NIM. So as interest rates get really low, it actually squeezes their NIM, and they've got to pick it up on their asset side, which is where they're lending. So as interest rates have gone out, you've seen an improvement in NIM. So they're getting that's a bit of a tailwind in the short term. So actually that's a growth in the short term for the banks. But what the other consequence, though, maybe this is a bit more longer term, is obviously as interest rates get higher, you've got the potential of higher loan loss provisions, which is the big impact on banks, and a slowing in the system growth. And so we're already starting to see a slowing in the system growth. Banks are starting to provide a little bit more provisioning, but they're still not really seeing it in the marketplace. But as interest rates go up and maybe there's more stress in the market, you do start to see a little bit more of that through the rest of the year. But we'll wait and see. So there's probably short-term tailwinds, long-term headwinds for the banks.
So where to from here? February reporting season's come and gone. Obviously, as we look towards the rest of the year, there'll be another temperature check in August around how companies are tracking. As you say, with your portfolio, you take a very long-term view on the opportunities that you include in the portfolio. Anything that's changed as a result of Feb, or any views that might change your thinking around how you position yourself?
Yeah, it's a good point. And the reporting season is always a bit of a check on the pulse, and it's obviously a great opportunity to catch up with the company. So we've had number of company meetings through February is incredible for us as each company reports, and then we'll have a chat with them and talk about trends, etc. So it is a bit of an opportunity to reevaluate, look at your investment thesis. Is that working? Is it not working? Where's the company heading? Is it as you thought? And I guess when I look at this reporting season, I guess it's pretty much confirmed the positioning in the portfolio. So I'm very much happy with where we're structured at the moment, and I got confirmation through the reporting season. So the fact that we are heavy in essentials, which is a bit more defensively positioned, but we're heavy in essentials, which I think is definitely the right place to be. So we saw good results from the supermarkets, Coles and Woolworths. Some of the other consumer staples did very well. Really demonstrates their resilience through a tougher period. Healthcare did really well, which is also part of those essentials. Ramsay Healthcare, which is a private hospital operator, got very negatively impacted through COVID, but it's just starting to recover. The hospital system's just starting to recover, so they're in a much better place. So essentials is a big part of it. We've got very little exposure to consumer discretionary goods, and I continue to be happy about that. There'll be a time to step in and buy some of these, but it's just not at the moment. I think things have to get a bit worse before we're ready to step in and buy those stocks. I'm also really interested in the cheap sectors, so I put insurance in that space, and so if I look at banks and insurance, we're a little bit underweight banks, but we've actually got a reasonable overweight on insurance companies, and we think they're in a really nice space at the moment. So we're seeing a tightness in that market, premium growth. So insurance companies, we've had a range of different natural, and these specifically general insurance, we've had a range of different natural disasters, which has really taken a lot of capital out of the sector, and it's tightened the market. So I'm sure you are, and everyone is seeing their home insurance go up, their car insurance go up, and not just a little bit, but significant amounts. So we're seeing a real tightness and premium growth for the insurance companies. They're in a much more attractive environment going forward. They are, and we're our one of our bigger overweights is Suncorp, which we think is really well positioned, especially as they start to simplify the business as well. But so we're seeing tightness in that market. The other thing that's helping the insurance companies is that short-term rate. So that when they get the premium, they've got to put the money to work and earn more money. So as short-term rates have gone from 0 to 4, they're now earning more money on those premiums they get in as well. So that's improved the model, and they're relatively cheap. So that's we think the whole insurance sector is in a really good spot, but we're particularly positive on Suncorp. And then also, I guess, in the resource space, in the commodity space, which I think is also of interest to us, we continue to believe that the transition materials, the lithiums, the nickels, the coppers, once again, are really well placed as we go through decarbonisation. So that is a major trend that's going to play out in a relatively short space of time. So you just think about this has got to play out over the next 15 or 20 years. So there's a huge amount of development that needs to happen in that next 15 to 20 years. And it's a big trend that's not going away. So decarbonisation is a very metal-intensive phase of development. So we think those specific companies within commodities are well positioned as well.
And Paul, finally, if you had to choose a movie or a TV series that sums up February's reporting season, how it went, what would it be?
Andrew, that is a tricky question. And I guess I'm going to slightly change the premise, if you don't mind. A movie that comes to mind, I think, in this environment, and a movie I absolutely loved is Eternal Sunshine of the Spotless Mind. Now, I definitely recommend it as a movie, but to me, it's also that movie is about people that don't like their memories going back and getting rid of the memories of a person or some sort of historic event. And to me, at the moment, we need to do the opposite. We need to be cognizant of history. We need to learn from history. And the history in these environments is actually probably a lot. It's not a recent history. It's actually going back a little bit. We need to be students of history. We need to look back through crises. We need to understand what happens in a recession or when we get close to a recession and what gets impacted. Because I think it's been so long, especially in the context of Australia. So we actually need to do the opposite. We need to maintain those memories. We need to strengthen those memories. We need to learn from those memories. And I think that's going to make us better investors in 2023.
Well, thank you, Paul, and here's to having a much better 2023. Appreciate you joining us today. And if you have enjoyed this episode, please share it with a friend or colleague and subscribe to your podcast via your favourite streaming platform. And we'll see you in a month. Bye for now.
Andrew, thank you. Great to talk to you as always.
Some important information on today's podcast. This podcast is issued by Full Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australian products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.